Bienvenidos to Season 3 of Humans in Accounting podcast. In a world full of AI, automation, and endless workflows, we pause for a moment to focus on the real humans behind the numbers. Founders, leaders, humans share their journey, what drives them, and the moments that shape their path. Because behind every balance sheet, there's always a story worth telling. Humans in Accounting is brought to you by South Offices.
Hello everybody, and welcome to a new episode of Humans in Accounting, where leaders and humans share their story behind the spreadsheets. I'm Alex Roman, and this podcast is brought to you by South Offices, connecting accounting talent across borders. Today I have a special guest, Geoff Bruskin, managing partner at White Tiger Connections. Geoff, I'm so happy that we're doing this together. Welcome to Humans in Accounting.
Thanks, Alex. It's a pleasure to be here with you today.
Likewise. The truth is that we never met physically, but we were talking before we actually record this episode. I'm not entirely sure, but we had a few conversations. I don't know if it was a year or a year and a half ago. We exchanged and we had a few calls, and I remember you studied in Argentina. You did something in Argentina. You went on vacations in Argentina. Something.
Yeah, so I studied abroad in college, Alex, in Buenos Aires. I was there for 4 months. Don't quiz me on my Spanish. It's not very good anymore. Tranquilo, it's not so good, but I had a lot of fun. I went to Iguazu, I went to Patagonia, I hung out in Palermo and Recoleta. So I know a little bit about your country. It's a beautiful place.
Perfect. So I'm gonna skip the first 10 questions that I had on Spanish, but I'll just jump directly. But I was gonna ask you though. So you stood here in Palermo. You were staying in Palermo. That's like
I stayed in Recoleta, like 5 blocks from the cemetery, and but Palermo, we went to hang out. Yeah.
Okay, perfect. I don't know, but if you came here, but I live in the north of Buenos Aires. That it's called Tigre. That's the only thing that you should know because of the name of your company. It's
of
Tiger.
course. It was meant to be, man, that we're here today.
Exactly. So, well, I'm happy that you visited. Unfortunately, we didn't meet back then, but next time you come, now that you know me, just let me know and we can hang out, all right?
You got it. Next time I'm in your country, or the next time you're in New York, you'll have to let me know.
Definitely, I'll do that. Geoff, let me ask you from the beginning. I know you're a managing partner at White Tiger Connections. I know what you do, but if you can tell us a little bit about how you started this company, what were the first steps? That would be great.
Sure. So I went to Penn State University, Alex. I studied international politics and philosophy. I thought I was going to go to law school, and I was rejected from a teaching program, which was going to be my stepping stone to law school. So I had no job prospects except for one, and that was recruiting executives for tech companies. So very different than what I thought I was going to be doing. I went into executive recruiting, and I did a lot of CFO placements. I did that for 3 years. I left. I took a sabbatical and did some soul searching and decided that I wanted to do something entrepreneurial. And so I started my own recruiting firm and was connected early on to a retired PwC tax partner who, in his retirement, he was doing buy-side mergers and acquisitions and management consulting for $100 million to $1 billion accounting firms in New York. And his clients needed partners recruited for their large CPA firms. So my mentor in the accounting profession, he white labeled me to be his head of executive recruiting. And I got to ride shotgun to him on the mergers and acquisitions projects and the consulting projects that he was doing for the super executives of these large accounting firms. And so I learned the CPA space under his tutelage. We did some recruiting work together. He fully retired in 2021. And that was right when Eisner Amper, which is a large accounting firm here in the States. They took their first round of private equity capital, and that was like the first big private equity deal that happened in the CPA profession. It was only in 2021, so not for very long has private equity money been in the accounting space. And so I saw the writing on the wall that the accounting space was going to go through a lot of transformation. And so I now had this unique set of skills, this complementary set of skills, the mergers and acquisitions, the recruiting, and the consulting. And they all go very nicely together and they reinforce one another. And so I came way down market, Alex. I stopped working with the $100 million plus firms because I didn't have a CPA after my name. I didn't have the kind of advisory credibility, not enough gray hair. But the lower market firms still needed a lot of support, actually arguably more support. And so in the last 36 months now, we've done 23 M&A deals, we've done 35 recruiting placements, and we've done 35 consulting projects. We will probably eclipse all three of those numbers this year alone. Over 24 deals. We have projected probably 40 or so recruiting placements, all fully remote, domestic in the United States. And then consulting wise, we have a number of fractional chief operating officer engagements with accounting firms ranging in size from $1 million in revenue up to about 20 million in revenue. And a couple of wholly owned by wealth management firms, a few private equity firm roll-ups, and we do all of the operational consulting for them at a strategic level and then manage their teams more tactically in technology, offshoring, workflow optimization, that kind of stuff. So we've got a lot of different things going on, and I think we're uniquely positioned to support the accounting profession from a lot of different angles.
Well, thank you so much. Thank you so much for that intro. I have like, I don't know, 3 follow-up questions. The first one that I have is I just want to know that sabbatical year, you went somewhere specifically, you stood at home, you did something on that sabbatical?
Yeah, I traveled and I lived out of my car for a while. It was not very glamorous. It was, deciding if I wanted to go back to work for someone or if I wanted to be barefoot all day. That's not for me.
Right.
So, like a lot of people do in their 20s, you decide what you want to do with your life. And so I decided I wanted to have a family and invest in my faith and be an entrepreneur. And so here we are.
Okay, perfect. So that was definitely you spend in the best way possible your time if you decided all those things. And then so going back, I mean, now basically you're working. Do you work mainly? I mean, only with accounting firms, or do you work with any other industry besides accounting?
So our core thesis, Alex, is accounting firms, but there are
Right.
a lot of things that kind of come off of the accounting firm center. So there's a few things. First, we have a lot of private equity that we work with because private equity are buying accounting firms or they're executing a thesis in the accounting firm profession. So we work with real estate investors, technology investors, venture capital firms, consulting firms, family offices, anyone who is outside capital that's investing in the space, buying firms, taking minority positions. So we call that private equity. Then we work with law firms because law firms are also starting to buy accounting firms and they're also recruiting accounting talent to build accounting functions from within. We work a lot with financial services firms. So that's financial planning and wealth management because their profession is actually under a lot of risk from AI. And their clients are starting to expect that they're going to get an integrated service, financial planning, wealth management, insurance, and tax. And oftentimes the financial advisor is not able to successfully execute his or her job for the client because tax is not integrated. So historically, financial firms wanted to buy accounting firms just to cross-sell their services into the accounting firm client base. Now they want still to do that, but actually more, they want to have the CPA firm be able to provide its services to the financial services firm's client base. So the tax, the accounting, which is what the wealth management clients are starting to expect. So that's actually a huge area of growth for us right now. And then, Alex, we will also get referrals from our accounting firm clients to their clients who are selling their businesses. So, for example, I have a couple of rock climbing gyms in Canada that I'm selling right now. I've sold marketing agencies. I sold a construction company. So we'll work really in any space because the expertise that we have is industry agnostic, but our focus is on the profession that is accounting.
Right. Perfect. That makes perfect sense. All that was basically because you were introduced to this. I mean, it was just by luck, I guess. It was not it's incredible whenever I really like just to ask the story of how people started their own firms. It's always like something happened because you were in the right place and the right time. Obviously, you were moving, but again, 97% of the cases, it has to do that. Yeah, something happened, and now look, a few years later. How long have you been in business with White Tiger?
It'll be 7 years in August of 2026. We started August of 2019.
Well, incredible. So that's super interesting, and it's great that you have these services. It's not only Emma, but you mentioned recruiting as well, right?
Recruiting and also consulting.
And consulting. All right. And recruiting, you do recruiting in the States. You do yes,
Exclusively in the US. We will very rarely do an executive hire overseas. Like I have a head of
right.
practice management that I'm looking for, like a $1.5 million CAS firm. He has a bookkeeping team in the Philippines, and so he is looking for basically almost like a light chief operating officer, and he wants that person to be based in the Philippines. So we will do executive hires overseas, but if we do 40 placements this year, 39 of them, 38 maybe, will be in the United States. Fully remote in the United States.
Fully remote. All right, perfect. Okay, let me. I have a few more questions that I want to ask you on this side, but I don't know how aware you are with humans in accounting, but some question that I cannot miss in this episodes, and this is just because I am a foodie guy and I enjoy eating good. I'll ask each guest what's their favorite food. And Geoff, you're not going to be the exception, so I'll go direct and ask you that question. What's your favorite food?
So, like the tiger, right? Tigre, you are living in that space, and I'm the white tiger. So, I'm definitely a carnivore, I have to say. So, I like a good veal chop. My favorite meal is veal chop Milanese. It has arugula base with the lightly fried veal chop, and then balsamic, avocado, tomato, and mozzarella, and with just the balsamic glaze with a little bit of the cinnamon in it. It is so good.
Did you have you're describing that dish, that plate. I feel that you have maybe a favorite place, I want to say, or is it something that you do at home?
Yeah. I'll make it at home too. I like to cook also, but mostly I go to. There's a place locally in my town which is walking distance from my office. It's top of my mind because I just had it yesterday. So yeah, it's good.
Okay, but hold on. Now maybe there are like 12 listeners that are in New York, and maybe they're close to that place. Just tell the place. What's the name of that place that it's close?
It's called American Beauty.
American Beauty. All right, like the movie.
Yeah, exactly.
Perfect. All right, that's definitely the first the I'm doing like a ranking of all the guests that came in and that were interviewed here in Humans in Accounting. That's the first one. While you were here in Argentina, have you had asado
Of
here?
course. Come on, your famous barbecue. How could I not have it? Yes.
Okay, okay. Perfect.
The
Good.
only thing that I did not like was the blood sausage. That was a little bit rich for me.
Okay, no, it's good. I always, in my case, yeah, definitely asado is probably my best food, but it's delicious. It's kind of like as you said, like a barbecue, but
Yeah.
it's more of the experience of just
Yeah.
being a few hours with a family and friends, and after having lunch or dinner, having a few drinks and spending time with the other. So it goes a little bit more over the actual the food itself.
Speaking of the experience, Alex, what about, are you a yerba mate drinker?
You're saying that because you saw this?
No, I didn't see the Bombilla. No, no, no.
No?
I described, because I have a few people in my company who are in Argentina, and so I will joke with them. It is, speaking of the experience, mate is very sensory because you have to, like, you have the metal straw and the scalding hot liquid, and you have to light your throat on fire like volcano, like in your throat. And this is like the experience, right?
Yeah. And again, this is something, in this case, I'm here by myself, but if we're with a group of friends, we all share with the same straw. I remember it was kind of an issue with COVID because, yeah, we couldn't do that. And like the whole experience of sharing a mate was kind of ruined. Well, it lasted a few months, and then I guess now if you go to a friend house, they're gonna offer you, and it's gonna be the same. But I'm happy. It's cool that you remembered. Well, that's because you have your team. Some of your team are here in Argentina as well. Let's go back. I have a few questions that I wanna ask you, just because I wanna know, like, do most in your experience, like firm owners, like, do they overestimate or underestimate the value of their own firm? I feel like everyone is going to say, oh, my firm, it's going to be all this amount of money, and then they realize it's not. Is there like a typical pattern that you see there?
I think different market, different market pockets either underestimate or overestimate, and then there are some who just are very, like, very trusting, which is great because if I can build a good relationship with them, then they're open to being advised. So those are my favorite clients that will listen to what I have to say, and they understand the logic and the reason of what I have to say. I just got off the phone with a guy half an hour ago who he does roundtables for. He works with slightly larger firms than most of the ones I do. His average client probably has like maybe 15 million in revenue and maybe like 3 or 4 million in EBITDA. And I would say my average client is probably more like 3 million in revenue with maybe 1 million in EBITDA. I will work with larger clients, 20, 30, 40 million, but it's most of my client base is in the low millions. And so his clients, they're not very, they have older partners who are just kind of, very traditional. And so they are not expecting to have a 10 or 11 times their net profit valuation. They see this and they're used to the historical 1 times revenue, 1.2 times revenue. That was what the space was selling for before private equity came into the market. In the
Right.
last 5 years, it has steadily risen. So for the folks who have not been paying attention, it's very, they undervalue their firm. On the other hand, you have people who run a six, seven, $800,000 revenue firm, and they think their firm is going to sell for $3 million, and it's like, no, no,
Right.
no, it doesn't work for that way. You get both. My favorite are the people who are just like, Geoff, let me tell you about my firm, and then let me hear what you have to say. And then it's my job to obviously build the trust and the credibility based on what I see in the market, how much I think we can price them.
Right. And from your experience, what is the thing that separates firms that sell well from yeah, those other firms that maybe have the decision of selling and they struggle just to find buyers? Is there any advice on that, or anything that you learned?
Yeah. The single biggest variable, number one, is how absent the owner is from day-to-day operations. So the more involved the owner is in running the firm, the less valuation and the less cash upfront on that valuation the owner is going to get. The more removed from day-to-day operations that the owner is, the higher the valuation and the more cash upfront the owner is going to get. And so there's two kind of super important variables for sellers, even if they don't realize this. One is, of course, the valuation. The other is how much of that valuation in cash upfront they're going to get, and how much of the remaining cash is going to be conditional upon some kind of integration initiative successfully taking place, Alex, and over what period of time. Is it 1 year, 2 years, 5 years, 9 years? And so if you're very involved as the owner of your company in client relationship management and training and mentoring the team and all of the SOPs live inside your head, etc., a buyer is not going to give you, they might give you a good valuation if you have very good clients and a lot of revenue, or a lot of profit, but you're not going to get a lot of that valuation up front. You're going to have to successfully transition that key role that you're playing onto someone on the buyer's team before you're going to be able to complete your full exit. And so now you're still involved in operations. You probably are selling because you want to retire, or you want to pursue other interests, or you want to work less. And so the earlier that you can start separating yourself above the business because you have people who are reliable, who are running it for you, the better your exit is going to be.
That's great advice, and probably something. Well, but you just put it on the words and the best order possible. So yeah, that's great. And let me ask you. I'm not an expert in M&A, but I understand that usually when there's a buyer who's interested in buying a firm, they go through a process of due diligence. Is there something that usually or always comes up during the due diligence process that you say, okay, most likely this is gonna come up, and maybe you're not surprised, and the seller is like, oh, I didn't know this was so important.
So the biggest thing that consistently comes up is the difference between SDE, or seller discretionary earnings, and EBITDA. So let's take a $1 million firm as an example, 1 million in revenue, and let's say that the owner is putting 500,000 in his pocket every year. He might think that that's 500,000 is the EBITDA, or the profit of the business.
Right.
It's not. It's what's called the SDE, or the seller discretionary earnings. So there's two ways that you could value that company. You could either value it as a multiple on gross revenue and call it 1.4 times gross revenue. It's going to sell for 1.4 million. But one of these sellers might say, oh, well, I'm hearing that some businesses are selling at 5 times EBITDA. And so I have a $500,000 profit. That means not $1.4 million, but I should sell my business at 2.5 million, right, Geoff? No. It's not like that, unless you are putting 500,000 in your pocket and you are completely removed from day-to-day operations. Like I said previously, very few businesses are run like this. Some are, increasingly actually now, because there's more savviness because of all the thought leadership that's circulating online. But most of them still do not work this way. The 500 is because the owner is doing a lot of work, spending 90% or 80% of their time working in the business and only 10 or 20% working on the business. And so for the $500,000 business owner who's spending 80% of his time in the business, we have to adjust the seller discretionary earnings, that $500,000 number, down to the EBITDA number, and we adjust it down on the basis of what is the fair market value of the replacement cost. If the owner was to disappear tomorrow, how much is it going to cost us to hire someone who will replace the function in the business that the owner is spending that 80 or 90% of their time? So let's call that, for the sake of argument, $250,000. Now you see a 5 times multiple on the adjusted EBITDA of 250 is only 1.25 million. And so all of a sudden that gross revenue multiple of 1.4 starts to sound a lot more attractive. But there is no exact science between gross revenue multiples or EBITDA multiples. This is something to do with the bank. Banks are typically financing and professional services based on gross revenue, while private equity are always looking at EBITDA multiples. And so we could change who we sell to. We could sell to an owner operator who's getting a bank loan because they're going to be more oriented towards a gross revenue multiple, where private equity would be more oriented towards EBITDA. But the reality is because the world has kind of merged between owner operators and private equity, each party kind of looks at things from both perspectives now. So my job is to craft a narrative, a story for the buyers that makes sense. We want to price the business as high as possible. So we might say, 5 would be $1.2 million. 1.4 would be, or 1,250,000, 1.4 times gross would be 1,400,000. But we think this business has really great bones because the owner, you know, a lot of his clients are very high net worth individuals. He's got a key staff who's not ready to step up into the owner box yet, but he's going to be a very strong number two who's going to be able to take over the client relationships in the next 2 years. And we want to price this at 5 million. And so that's actually a 6 multiple on adjusted EBITDA or 1 gross, which is aggressive. But because there is so much demand right now, there are way, way, way more buyers than sellers. I think about how high can I price this for a seller where I am not being unreasonable, but I am being aggressive by the market standard.
Okay, perfect. I have to ask you, when I started this podcast, you know, we're humans in accounting, and I tried just to go. We were all talking about AI. We are keep on talking about AI because every week there's something new that it's coming up. Is AI changing the type of firms that get acquired? Is there anything that you're seeing from the AI perspective? Something changed on this last, I don't know, months, year, not more than that?
So it's changing the outlook and it is changing the reality, but it's changing the reality slower than like everybody in the news is like, oh my God, it's going to change the world. It's coming for us all. It is coming for us all. It is going to change the world, but it's happening, you know, it's happening very fast, but it has not happened yet. It's still in the relatively early stages. I am seeing a lot, and I advise a lot of my clients in the consulting work that I do, Alex, on implementing AI into their firm to reduce or eliminate the redundant tasks, especially tax preparation, administrative items, and it's coming for bookkeeping pretty soon. There are already Claude agents, which are widely distributed to the market that are, I don't know about replacing the bookkeeping function, but one senior bookkeeper could now do the, you know, now today on April 15th, 2026, that can do the job of, with the right infrastructure behind him, could do 4 or 5 bookkeepers' jobs if the right, and that's today, right? What's coming a month from now, 3 months from now? But how many firms have actually been successful in implementing this? You know, maybe 6 months from now, I think it's going to be 10%. And a year from now, I think it's going to be 25%. So I do think that there is a massive wave of transformation that's coming, but we're at the very beginning of it right now.
Yes, I agree. I agree. And let me ask you, I usually ask guests this question that I really like asking, that it's basically, what's a piece of advice that you could give maybe someone starting their April 2026? But I want to add something to that question since I'm asking this to you, Geoff. Let's say that someone is starting now an accounting firm, a startup that it's an accounting firm, and they already have a plan of selling this accounting firm that they're starting now in 3-5 years from now. What's a good piece of advice? You already mentioned a few, but if you kind of say one thing that you can tell them, maybe someone in the future is watching this and it's in this exact same situation. And yeah, well, what's a piece of advice that you can give to them?
So I will give you 3. Number 1, go fully remote. Even if you are attacking a very specific local market, go fully remote, because you will stop the amount of foot traffic, which is going to free up your time and your people's time. And you will also enable your hiring to be completely location agnostic. And with the talent crisis that we are in right now, it is so important that you do not have geography restricting the talent pool more than anything else, that you are acquiring, you know, your key people through. Remote, digital is number 1. Number 2 is hire, not necessarily, it could be a chief operating officer, but you should at least hire a very good practice manager who is at the very most junior, a senior kind of executive assistant type person. So it could be someone overseas, it could be someone in the United States, but a senior operational leader. And they really can have like the bones of someone who's just an executive assistant, right? Very organized, very loyal, very good attention to detail, willing to take on any kind of task. And because they are like attentive to detail and they are operationally inclined, you can teach them if they don't already have this skill set. Again, depending on how big your vision is. Like I have a company, just brief story. I have a client right now that is venture capital backed. He's bought 2 firms so far. He's going to buy another 4 to 6 firms this year. He wants to buy 5 to 8 firms next year. He's looking to get to 100 million in revenue. He has a technology thesis. He already owns another firm that has 12,000 clients. He's got a tremendous infrastructure. He's hiring a COO right now, right? And that's just a bigger vision. For somebody who wants to build a $3 to $6 million firm in the next 5 years, you don't need something like that if you're just starting out. But you should have a lieutenant who is really good with workflow, so that that person can manage your technical people who are actually delivering the work product for you. And that person should be passionate about AI, because there is so much opportunity for AI optimization in the workflow environment that sits on top of your practice management software, Carbon, Canopy, Practice 360, Engagement, Practice ERP, all of these PMSs, right? That you can build in TaxStone, so much of automation. And so you want a practice manager who is excited about that. They don't have to do all that work themselves, Alex, but they should at least be excited about it, right? So that's number 2. Number 3 is pick a niche, some kind of specialization. Real estate, crypto, professional services, doctors, oil and gas, agriculture, law firms, financial services firms, expats, international who have nexus in the United States, or Puerto Rico, US is a huge thing that I see because it's a territory and there's all of these cool tax implications. Pick some kind of specialization and then branch into multiple services in that specialization. So tax and accounting, financial services and tax, accounting advisory in the same niche. Yes, so that you're providing a comprehensive solution for that niche. Because now you're going to gain stickiness and you're not going to be threatened by your client who says, let's say you do bookkeeping for construction firms. Well, your client, if you're getting all of these, marketing emails from, if you're watching Claude right now on LinkedIn or Twitter, talk about how it can automate bookkeeping, and the industry experts are talking about that, right? As an accounting firm owner, it's going to be 6 months before there are, out of the box products that are selling you a bookkeeping automation product. Fully done for you bookkeeping automation, right? How long is it going to be before there's a company that's selling to your clients full out of the box bookkeeping automation specific for the construction industry, right? It's coming for you first, and then it's going to come for your client. Well, how do you defend against that? You have multiple complementary services to the same niche, so that you're providing a value-based experience. It's not a task. It's not even a project. It's actually a program that you're providing to the client. So those would be my 3 suggestions how to think about starting a firm today.
Geoff, that's really good advice. Thank you so much for this. I'm sure there's someone in the future doing exercise, maybe driving their car, for some reason watching this or listening to this, and now they're just driving and saying, hey, I just want to talk with Geoff. What's the best way just to reach out to talk with you? Maybe they're thinking of doing or selling their firm. How can they get in touch with you?
So LinkedIn is great, Alex, and our website, which is whitetigerconnections.com. Those are the 2 best ways to reach me.
Perfect. Actually, when we post this episode, I'll make sure just to put you there so that people can reach out. I'm super happy that we made this episode. Super looking forward for next time. If you come just to Argentina, we can share. Of
course, I would love to.
A good asado and a few mates together. But thank you so much for being part of Humans in Accounting.
My pleasure. Thank you, Alex. Take care.
Bye-bye.